In this concept video, we're going to look at preparing the cash budget. Now this is probably the most important budget of all. It shows us what our cash coming in is, which are cash receipts, and what our cash going out, our cash disbursements are on a monthly basis or a quarterly basis. And if the disbursements are greater than the receipts, then we need to borrow money. So basically it looks something like this. We start off with the period, any company cash budget. We start off with the opening bank balance. We add then the cash coming in. We itemize that. Mostly it will come from cash sales and accounts receivable being collected. Those two together give me the cash available. From that I subtract my payments. I itemize those. That would be purchases of raw material, direct labor, manufacturing overhead costs, and any one-time type of expenditure like buying a piece of equipment. Now, if the disbursements are greater than cash coming in, we have a deficiency, and therefore we have to borrow money. If our cash receipts are greater than cash disbursements, we have an excess, and we can pay back then the money we borrowed in the past, or we just carry that excess forward. Now this is all best demonstrated with an example. Hayes Company. We're starting the budget period January 1st, 2014. The cash balance at that time is $38,000. We want to maintain a $15,000 balance. So if we go below 15, we have to borrow. Sales are 60% collected in the quarter sold and 40% in the following quarter. We start off with accounts receivable of $60,000. Okay. There will be also short-term cash sale of investments. Direct material purchases, 50% are paid in the quarter purchase and 50% are paid the following quarter. We start off with accounts payable of $10,600. Direct labor, of course, you've got to pay the labor when it's due, so therefore it's paid in the quarter that it's incurred. Manufacturing and selling expenses are all paid in the same quarter. Keep in mind we don't pay for depreciation. We're also going to purchase a truck for $10,000. And lastly, we make equal quarterly payments on our taxes, and loans are repaid in the earliest quarter in which sufficient money over $15,000 has been collected. So now we start with the cash collection of receivables, expected collection from customers. We have sales, cash sales, but this is receiving the accounts receivable. And recall we started off, the accounts receivable was $60,000 in quarter one. Okay. Now in the first quarter we had accounts receivable of $180,000. They tell us 60% in the quarter in which I made the sale. So I made it in quarter one and I collect $108,000 of that. And 40% in the following quarter. So the balance, $72,000, I get in the second quarter. In the second quarter I have accounts receivable of $210,000. Well, I collect 60% of that in that quarter, second quarter. It's the second quarter. That's $126,000. And the balance in quarter three. In the third quarter, $240,000. I collect $144,000, like that, and $96,000 in the final quarter. In the fourth quarter, I'm only going to collect 60% of that $270,000, so I'm going to collect $162,000. Now I add them up. So in the first quarter, I have $168,000 coming in. In the second quarter, $198,000 coming in, $228,000 in the third quarter, and $258,000 in the final quarter. Now for purchases that have to be paid on the direct materials, they tell us we're starting off with an accounts payable of $10,006, so we have to pay that in the first quarter. And we are going to purchase $25,200 in the first quarter. So we're going to have to pay half of that in the first quarter and half in the second quarter. Now the same with in the second quarter, I have purchases of $29,200, so I'm going to have to pay $14,600 in the quarter in which I made the purchase, $14,600 in the following quarter. By the same token, I have to pay $16,600 in quarter 3 for the purchases in quarter 3, and $16,600 in quarter 4 for the purchases in quarter 3. And in quarter 4, I have purchases of $18,600. So I total up my cash going out for the quarter: $23,200, $27,200, $31,200, and $35,200. So my cash, when I do everything, my cash budget would look like this. Beginning cash balance $38,000. Add cash receipts for the first quarter $168,000, plus remember the sale of securities. Cash going out first quarter $23,200, direct labor $62,000, manufacturing overhead, so on and so on, income tax. $208 minus $182 is $25,500. I'm above the $15,000, so I go to the second quarter. I start off the second quarter $25,500, in comes $198,000, out goes $211,500. I only have now $12,000 left, and so therefore I have to borrow $3,000 to bring it up to $15,000. In the third quarter, I start off with $15,000, in comes $228,000, out goes $220,500. I have a balance of $22,500. I must maintain a balance of above $15,000. I have X money, so I can pay back the bank, which I borrowed, plus interest. So I borrowed $3,000. I have to pay them back $3,001. Then I start off the fourth quarter. At the end of the year, I should end up with a bank balance close to that. And that is how we prepare the cash budget.